I'm checking out. What's your dog's name? Maggie.
All right. So Consulate U, next class. One of the questions I get asked a lot is why do you buy the things you buy? And the other question I get a lot is, you guys are buying a lot of things, and so forth. So
Portfolio management.
Portfolio management. So I thought it would be important to bring Chris O'Shea, the CIO of the company, who's making a lot of these decisions, along with myself, to talk about, how do we make decisions? How do we find things to buy? Why do we buy them? Why all these trades coming in and so forth? And this is going to be a unique seminar, Chris, because you will talk more than me. So you go ahead.
That remains to be seen.
Go ahead.
We're pleased to be here. And so we do want to run through several things because as we do this together, the biggest thing that comes up, I guess, is how do you do what you do? And so we thought we would just start with that piece of it first. Research tools that we use. We're using passive funds, but we're using active funds. So majority of people
I guess you got to explain the two, don't you?
That's correct. And so, yeah.
You want me to do that, or you got that?
Well,
I'm going to do it
tee
later.
That up for you. No, I'm going to tee that up for you right now.
Yeah.
So in that, again, we go through the research in a different way. So most people are in active portfolios. So describe for folks the active versus passive.
So in an active portfolio, you're making decisions on macroeconomic things. You're making decisions on fundamentals of companies. You're trying to use your knowledge of the investment world and what makes stocks and markets go up and down, and moving in and out between them, and trying to make solid investment decisions and capture what you would call alpha. Alpha would be making a return either beyond the S&P 500 and other international indexes, or a return that maybe isn't as high but is less volatile than those indexes. So markets can go up 30 and down 30 or 40. And if your portfolio goes up 26 but only goes down about 10, that would be considered a success if that's what you're trying to do. Get a good return with less volatility. That's active management. Passive management is where you just say, whatever the index does, I'm happy with it. If the index goes up 30, I go up 30. If the index goes down 30, c'est la vie, I'm going to sit and wait it out. Active versus passive. And in passive, all they're doing is buying the stocks that make up those indexes. Right. And there's no thought process as to are they good stocks or bad stocks. The index says that Procter & Gamble's in it, Apple's in it, Alphabet's in it, General Motors might be in it. If it's in it, they buy it. If it's not, they don't. End of the story.
And what started that craze, that trend, was the S&P 500 buy that. Well, we don't just buy that index and call it a day.
There are tons of indexes now.
Yeah, so we diversify.
Right.
I think you need to do that. International, U.S., large cap, there's large companies, small companies. But embedded within, so we think both styles work. There's a place for both. So embedded in the active management, though, we use passive funds. So we're using those. Expenses are low. We want exposure to certain markets, so we do that. So, we're putting portfolios together, but today we're not going to be talking about the portfolio creation, construction from the passive side. We thought, okay, we want to talk about what are the things that you're seeing on a regular basis. You get questions, fair amount on, okay, why are you buying here? What are you doing? Our active funds, we're using a couple tools to do that.
Yeah,
we're looking at active funds. We're looking at this FI 360 that we use, and we use Morningstar. More people probably heard of Morningstar, but we're using an advanced software of theirs called Morningstar Advisor. And so we're looking at a lot of different things when we're going in there. So we're going to talk about some of the research tools.
Yeah, so the first thing we're going to do is we're going to look at FI 360, which is a program that we can look at all the funds that we currently own, right, and see whether the costs are in line, the rates of return are in line historically, see if the management of the portfolio has changed or anything of that sort. And what happens is it uses colors. And if it's a green color, that means that the costs are in line, the rates of return are in line, the management is aligned, the stewardship of the fund is in line. If it's yellow, that means there's a caution flag out there. Something about that fund that either has high cost or their performance hasn't been as great as it was, or there's been a management change, and you need to be cautioned about that. And it doesn't mean that you can't own it. It just means that you just need to know why there's a caution flag out there, and can you understand why you're going to just ignore it or why you're going to replace the fund because of that. And then the third is the red flag. The red flag says, we don't understand why you'd want to own this fund. You better have a darn good reason why you'd want to own it, because performance not good, costs aren't good, et cetera, et cetera. So we have owned red flag funds that worked out for us, but we've also had red flag funds that we realized, hey, something's got to go. This thing's just not doing what we thought. We'd give it some time, but time didn't work, so let's get rid of this thing.
Right, and these come out quarterly, right? So it can, because when people are, some funds only release it quarterly on the filings that they have to do. So the software will get that, but we're looking at these things more frequently. We're looking at them monthly because people will make available, not the formal filings, but will make available some things. So we're already seeing things, but it's also a comparison to their peers or indices to see how they're doing. So we do like that. Again, the green, yellow, red, we think those things are very important to do. It keeps us online to at least look at them quarterly.
Yeah, it's very
officially.
It's very important when you have a 401k, a company 401k. So if you're a business owner and you have a 401k, somebody has to be monitoring this, or else the employees could come in and say, look at all the red and yellow funds they have, and the costs are way high, and the lawyer would love that, and so it's called a fiduciary reporting for 401ks. But that's a little sidetrack. You go ahead and so now we've got.
Okay, we do that. We use that really as not as an ongoing tool to monitor what we have, but we also use that as we run that through the last screener before we buy, after we've screened initially with things like Morningstar. But we'll come up with ideas. We hear somebody talk about it. We read the many things that we read. We see an idea. Oftentimes, what we hear people tout, though, it's more talk than performance. So things like Morningstar Advisor allow us to go in there and say, okay, we hear a great story. It's compelling. We see something, but what are the numbers telling us?
Yeah.
And so, and sometimes we go in with a specific idea. Other times we say, we like this area. Let's look at who's performing the best in this particular sector.
Yeah. So, we always, Chris, want to have an allocation between large cap, small cap,
right,
mid cap. We want to have international. We want to have U.S. And since we live in the U.S., we want our investors to have a U.S.-centric portfolio, right, because currencies, the European stock market could go up 15%, but if the euro goes down 16%, I'm still going to lose 1% as an American, because I do business in dollars, and the euro just lost 15% or 16% to the U.S. dollar. Even though my portfolio went up, I lost money because of the currency. So we tend to favor American securities, but that's still, we need to be, there are times when the dollar is not going to do well. And if the dollar's not doing well, that's when I want to own international securities. And so that's going to be a diversifier that we're looking for. For example, a lot of people give us a hard time because our international holdings hold our portfolio back to just purely the S&P 500, right? And they say, you're only making 11%, and the S&P's up 19%. Well, but the internationals are only up, 11 or 12 too, and so
the global funds
or global funds, and and so in between 2000 and 2010, we looked like rocket scientists because the dollar was going down and the international markets were making it look brilliant, not only because they were going up more than the U.S., but their currency was doing even better and adding to the internal rate of return. Now, for the last 6 or 7 years, it's kind of flipped. So our international holdings hold us back some, and it doesn't make us look as wise. But that's part of what we do as managers, in portfolio allocation.
Right. If you haven't been for the last 5 years in large cap US solely, you've underperformed a little bit compared to the S&P, because the S&P is so heavily weighted.
And a lot of clients, they'll go into their 401k and they'll put all their money into the S&P 500 because they look on the forum and it says, that's the fund that's performed the best over the last 5 years. And they say, okay, that's where I want to be. And then they think, they're doing fantastic. Well, you're doing fantastic until the S&P 500 doesn't do fantastic. And there have been plenty of history to show that there are times that they go 5-10 years outperforming, 5-10 years underperforming.
Because in general, equities will go in sync over the long haul, right? So you've got the regression to the mean. So they outperform for a while, and then they're going to underperform because overall they're pretty close.
Right. And
so to ignore one at the expense of the other is just short-sighted, we feel.
Right. But then when you're using Morningstar, what you're doing, and we're typically using Morningstar for the active portfolio manager. Now, what does that mean again?
We can do it. We do it for the ETFs, but we're the passive funds, the
index,
that we use, the index funds. But let's talk about the active side.
But the active managers is where somebody's coming in with their research team saying, I am providing value to you for the money that you're paying us. And we want proof of that. Right. And so your team is going in with Morningstar, and you're looking, and one of the cool things you guys do a lot is what's called a scatter plot, where you're taking all the global value funds. Okay, let's just take that.
Sure.
And you're looking, and there's a dot down here, and there's a dot down here, and there's a dot here, and there's a dot here, and there's a dot out here, and there's a dot over here. And here's what the index that those funds were competing against was doing right here in the center. Now the question is, what does all that mean?
Sure.
So I don't know if I set you up or set you down.
No, it's exactly right. So we do it from a geographic map. We've just done something internally that we think is best to do that, because we said it, take the U.S. map. And so what it's doing is it's taking risk, and a lot of things we're going to talk about today is risk and return. Okay, to compete, we want to do it together. We want to manage risk, and so we want return, but we want a risk-adjusted return. Our preference would be to outperform on the downside, and maybe not perform to the absolute best on the upside. But again, the reason we're using active funds is because they need to be performing better than the index, or why not just buy the index?
Right.
So on the geographic, if you're upper left, that means you get a high rate of return, and you're risk adjusted. Your volatility is less. Your standard deviation is less. So our preference is to find things that are in the state of Washington, let's say.
Yeah.
All right. Versus in Florida, because in Florida you're taking risk. So your standard deviation is way out there to the right, and then your return is down compared to the index. So we don't want Florida. We want Washington State.
Right. Now, let's just make a disclaimer here that, yes, that's what it says, that this fund up here has lower volatility and does still get a good rate of return. No assurance, though, that it will continue to do that. But if you get a good track record going 10, 15, 20 years, and you can look at the portfolio, you can look at the style of the manager, and you could say, there's something about what they're doing. We got a good feel for what it is. We believe in it, and that's why we believe that this is going to continue. We can't guarantee it, but we believe that it's going to continue.
Right, because we're looking at 1, 3, 5, the 10 years. We're looking at the past, but again, who's different? Who's not going to be just regressed to the mean over time? So there's no guarantees in that. That's why we do the FI 360. Okay, how are they doing? Are they drifting from their style, from their asset class that they're supposed to be in? So again, so we look for those that have a track record of just different market cycles.
The average client listening to us saying this would say, well, you just want to buy that.
Yeah,
that's
sure.
Just buy 100% of that. You got you do better on the downside and you do almost as well on the upside. Just buy all that. But what happens is part of the reasons they do that too is that in a year that the S&P 500 is up 25, they may be only up 9, but the next year the S&P 500 is down 25 and they're up 1. And next thing you know, the volatility and the works out, but the client's not necessarily going to understand. So that's why we want to have a combination of these index funds and these active funds. And also, if that active fund falls off the chart, for some reason, something happens, and all of a sudden they fall. And we've had funds that we've seen do that after 20, 30 years of incredible performance. Yep. And all of a sudden they just fall off the chart. You want to have those index funds to constantly keep your portfolio in the game if it's doing well, and that one's not. So there's no such thing as a utopian investment.
And we don't want to go into the diversification has all the attributes that we want, right? So you're diversifying. If something's not doing well, something else is. We don't want to go into what some in the industry have called diversification, right? You diversify to the extent where now it's hurting you.
Yeah.
We don't want to do that, but we also can't be S&P 500 fund because although you may want to be putting money away for the long term, oftentimes people need money sooner than what they thought they did.
One thing, though, we almost always insist on is that our portfolio managers, and this is one of the reasons we like index funds a lot, is that they don't trade the portfolio a lot.
Right.
We don't like managers who turn their portfolio. And what's amazing is that almost the majority of actively managed funds probably turn their portfolio over at least 50% a year, if not 100% a year. And we like managers who are in the 5 to 20% turnover per year at the most. 20% is like the high end that we like. And there's a reason for that. That if every year you're turning over that portfolio, every year you got to keep finding the great stock. Whereas if you just own what you believe are good stocks and just hold on to them, if you really did good research, they will work and they'll just continue to work long term. So anyway,
in some cases we accept something with a little higher turnover because we like the fund so much,
or there's something unique.
And there's certain times where we are over the long haul we are going to be tax efficient as much as possible. There are times when. But we don't want the adage is we don't want the tax dog, the tax tail wagging the dog. So we want to go for return first, but we know what helps with that is tax efficiency.
So let's go into why clients get a lot of little trades and so forth. So
sure. The
rebalancing, tax loss harvesting, that's coming up real soon. So
it is, especially if we have some gains for those taxable accounts this year. There are some gains. Well, the markets have been up. So rebalancing is, we rebalance on a daily basis. We run the rebalancer every day. So before the market's even open, the portfolios have been updated. They've been rebalanced. The question is, do we actually act on those, right? So it's ready to go in any time that we want to do that. Rebalancing, though, we know can trigger. Most of the time, our transaction costs are minimal because most of the things we're doing are ETFs and they're no fee, or the funds that we're using are no fee. There are some that we have that do. But anytime there are people are taking flows are coming in or out, you're depositing money in or you're taking money out either on a regular basis or an interim basis, just periodic basis, the portfolio will get rebalanced. So even though you think, well, I've got $20,000 of cash, just give me that. Well, that $20,000 is not just there to provide one-time needs for money. It's there strategically. So for us, once we do that, we want to balance the portfolio back to give us that dry powder.
So let's look at this. So you got a portfolio, and we have an allocation. It says 10% large cap U.S., 5% mid cap, 5% U.S. small cap, international large cap, Asia dividend, small cap growth. And it's got all these percentages, bond funds, and then lastly it'll say 6% cash. Let's say, okay. Yep. Somebody takes out 50% of their cash, or they put in 50% cash into their cash. Now the cash may only be $50,000, and they take out 10. Yep. That's 20 20%, right?
Yeah.
Or if they put in 10,000, that's 20% cash coming in. Now cash has gone from 6% in our model, that after that withdrawal, either down to 5 or up to 6, and now there's more money in there than what our model says. And so now your question is, or what you're saying, rebalancing says either figure out how to get cash back into that account so that it comes back to that percentage,
right,
or figure out how to get cash out and put it into things to get it. And if you don't do it amongst all the securities, it's not going to balance again, right?
Sure. Now you've got your design now has been broached, right? So
right.
You're going outside the lines of what you're intending for diversification.
And we
purposes.
can do a little of that, but
sure.
we can't allow it to get too far out of line, or else, because then this client will be dramatically different than this client over here, and yet they have the same goal and objective, that they don't want that much volatility in their portfolio. But if you allow the cash and the bonds to all disintegrate, and now they're 90% equities, that's what would happen if we don't constantly rebalance.
Right, because you can rebalance either just time only, you just do it once a year. You can do through thresholds. Okay, so we wanted to own 5% of this small cap fund, but now we only own 3%, so we need to buy some more back in. Well, we do a combination of both. So it's time and thresholds. We allow it to move a little bit, but we especially when there are cash flows, though, that demands that you bring it back into. You've got to take some action.
Yeah. And
so we choose at that point to allow those little buys and sells, even though it looks that they're not. So we're trying to do it. There was a time when we did that more frequently. That was several years ago. So now we're really doing on this from the standpoint of when it's material.
Yeah. So you've got the rebalancing going on, not only when clients are taking money and putting money in or taking money out,
right,
and things of that sort. But then you also have the rebalancing that if at the end of 2019, if the S&P 500 goes up 25 and the international funds only go up 1, your U.S. exposure is now rising and your international exposure is declining. And instead of having, let's say, a 60-40 U.S. to international, we're now at 68, 32 or something like that.
Right. And if our overall context has changed, where we say, okay, we like that trend, we're going to go with that, then we leave it alone. But if we're still in the mode of, wait a minute, our intention was to have this allocation, then we have to bring it back in line to that.
And so, like right now, we believe that there's more reason to believe that the dollar could start to weaken around the world in the future. It's been on a major up move for the last 5 years or so, but there's reason to believe that the dollar could weaken. And there's a lot of long-term belief that it'll really weaken if we ever lose the world reserve currency status. And if that were to start happening, and we believe that it's a done deal, we would want to bring our international exposure up a little more to make sure that we try to take advantage of something that we think is going to happen, could never get sure.
Right. So just to be clear, that's nothing impending. We don't necessarily. There are people
at this point in time
beat on the drum and say we're going to lose world reserve currency status. Well, right now there aren't a whole lot of contenders. To come behind us.
It's probably 30 years in the future. It's not going to be true anymore. That's 30 years. We're not worried about it today.
Well, it's a risk for all great societies who do. I mean, others have lost it, have had it, and have lost it. So
Britain was the last in the last 100 years. They
were
the pound, and they lost it after probably World War I. Definitely for sure after World War II.
Worth $5 in World War II.
Yeah, absolutely.
Now it's worth. What,
it was worth $4 when four US dollars made 1 pound when I first started in this business.
You started back in World War II.
Yeah.
Sure. So yeah, it has changed. So that's so those are the reasons for
those trades.
those trades.
Those trades. And then there's another thing, tax loss harvest selling. And so one interesting thing about mutual funds is mutual funds actively manage, or even index funds, any income they make has to be distributed to the shareholders. That's the law. That's how they operate. So if I'm a mutual fund and I bring in $1 million of dividends and $1 million of capital gains, I have to distribute 90% of those gains in order to be classified and taxed as a mutual fund. So they're going to distribute it. No ifs, ands, or buts about it. So let's say my fund sells for $10 a share, and that's when I buy it at 10. That's called my cost basis. Well, when they distribute that money, the fund in the marketplace will drop by the amount of money they distribute. So I bought it at 10, they distribute $1, the fund will now trade for $9 a share. Now that fund over time can start reclimbing because it's making money and stocks are going up in its portfolio, and might go back up to 11, let's call it. But in that period of time after that distribution comes out, and compared to your cost basis, the stock looks like it's lost $1 a share.
Right.
So it looks like, you look at it and you say, well, wait a minute. You just lost $1 a share. You're at 9 and you bought it at 10. Well, you forgot that I got $1 worth of distributions. So, technically I'm still at where I want to be. So what we can do is we can go in and sell that fund, take the tax loss, all right, even though we didn't actually lose money, but for tax purposes, they say we did. And now what I have to do is immediately buy an exactly similar fund.
Substantially similar.
It can't be exactly similar, can it?
Yeah.
If it was exactly similar, it would be identical. And it can't be identical. It's got to be substantially similar. Thank you. Substantially similar fund. And if it's substantially similar, I don't lose the economic opportunity, but I can take the tax loss. If I get a exact duplicate fund that I've reinvested in, so I buy the Vanguard S&P 500 fund and sell it for the tax loss, and buy the Fidelity S&P 500 fund, the IRS says, no, I'm not going to let you take that as a tax loss. Right. But
that's a substantially similar. It needs to be a little less than that.
But if I buy the S&P 500 fund from Vanguard, and I go over to Schwab and I buy the Schwab Total Market, or the Schwab Large Cap Market, which isn't the S&P 500, it's just Schwab's own index called Large Cap, then even though it's going to duplicate about the rate of return this is going to do, I can take the tax loss and not lose any of the economic opportunity. So mutual funds allow this unique situation to happen sometimes. Now, if a fund's gone up a lot and they haven't sold many of their stocks inside their portfolio, even with dividend distribution, it's never going to get back down to my cost basis.
That's correct.
But a lot of funds do distribute so much every year that they can drop back below, and that's actively managed funds. Right. Index funds don't do this. Index funds only distribute the dividend every year. For the most part, they never really sell the stocks in their portfolio.
The index doesn't change. It only changes infrequently.
And when that index changes, they're doing a swap, tax-free, not a sale. It's a unique scenario.
S&P just added somebody. S&P just added a company that we know. I just can't think of it. So they added a fund. They added a company, so they took one out. Right. So there's a change. So
indexes can, instead of actually literally selling, they can go in and take the one out and put the other one in as an exchange as opposed to a sale. And so there's no tax consequences when they're adjusting the index on them, as opposed to an active fund. When an active fund says, I don't want to own this anymore, they have no choice but to sell it. However much gain that distributes, it's got to be sent out to the shareholders. And so active funds tend to distribute their gains out, that you can drop below that cost basis, show a loss, and now it's up to us to determine, do we want to harvest that tax loss and buy something substantially similar so that we can use the loss and not lose the economic opportunity.
Correct.
And that happens a lot in bond funds, because bond funds don't have those big
capital
appreciation,
sure.
capital gain things.
That's right. Certainly not to the extent that the equities do. So, because no one likes paying taxes, and we know that. We want to be efficient. We're planners, and that's what we do. So when we can, we want to take the gains that are there because we've made some changes and lessen them,
right,
for tax purposes.
So we're using some selective tools, FI360. We're using Morningstar. We have others out there that we use quite frequently also. Vanguard's got a great advisor tool that you can compare funds against, lots of different categories and see, and so forth. We're looking at FI360 to tell us, how do they stack up against other funds? Do they have low fees? Do they have good stewardship? Do they have stable management? Do they have good historical performance over time and so forth? And there's lots of other tools that we still use, but there's others that we're even looking at to try to determine, will this add something to our portfolio? Some of our individual stocks we use Value Line. Obviously, it's a great service to look at. What does
a snapshot? Right. Is it worth pursuing it in detail?
And and the client comes in with a stock that they've owned for a long time, and we want to keep it, but we want to also make sure that there's nothing alarming going on about the company.
Well, we look at interviews with folks, interviews with managers. So we're hearing what they're saying, what they're producing, but we also want to hear what they're saying. So whenever we can, we're paying attention to the media, whenever they're being interviewed, and also when people are writing research reports on these things. So we're getting, again, we're data folks. Even me, I'm the old trivia guy from baseball, so I love facts and figures and analysis. So we're looking always to wherever we can to get input from trusted sources.
Yeah, there's tons and tons of people that give you your opinion,
right?
But there are only some that we've noticed over time that when they say something, you have to take it seriously because they've had such a good track record. It's a marketing thing at a lot of mutual funds and brokerage firms, that they send their people out that, give their pontificate on things, right, and they hope that they're right when they do. And if they do, they go out and say, see, he said 2 months ago this was going to happen, but then you find out that 2 months later he said something else and it didn't happen. 2 months later he says another thing, it doesn't happen. And, you're thinking to yourself, but we have some. Liz Ann Saunders, right? You like, she's not perfect, but it's interesting to listen to her because she has a good track record.
She's comprehensive in all the things she looks at. She's got a good track record.
And
she's
being consistent.
Reasonable, and she's not
a fear monger,
and she's not trying to be this prognosticator.
Right. She's trying
to say, okay, here's what it looks like is happening. She'll do that. But her bent is not to go out and make these grand predictions like Joe Granville from years ago, or who was the one who called the crash of
Elaine Gazzarelli. She's come around and she's done a pretty good job over time. But you're right. After she, quote unquote, she was constantly predicting, and then I think she said, that's it.
Right.
I realize what I'm doing is ridiculous. So. But you get guys like Michael Hassenstab, Templeton Fund. He's definitely not somebody I'm going to bet against. Jeff Gunlock, I'm not going to bet against him. He can be a little wild in his predictions sometimes. You got to understand also when you listen to these people, how what is their tendency, even though you think they have a consistent record of being relatively good, but are they exaggerators, or are they more like Liz, where they're very stable, very consistent, and you feel like you can really trust what they're saying? So you got different kinds.
And then we've got our internal filters. So we want to hear what they're saying and not just take it as, okay, why are you saying what you're saying? And then we're looking at the particulars to see how that impacts everything.
You might be amazed that I have an opinion every once in a while too.
Every once in a while.
So,
and we believe in that, just the bringing those things together, the sharpening that happens to whittle it down to, okay, what does it mean in the end? And that takes for a full exchange of ideas.
And then why do we trade? We're trading to make sure that we line up with the model. We trade because money's come in or money's come out, right, because we're rebalancing. You don't just take things from cash and not realize that now your model's out of whack in some way. You don't allow a bunch of money to come in and just let it sit there. It's got to get reallocated. And then we're doing our tax loss harvest, and that'll be something we can do all during the year, but mainly it's October, November that we're going to start looking at in detail.
Right.
And you don't sell something just to lock in a loss, because you're thinking, hey, I got a loss, let's just take that loss. You're locking in the loss because I can get something substantially similar, not lose any of the economic opportunity.
And there's a reason we do that. There's the wash rule.
There's the wash rule. Why don't you explain the wash rule? You're a CPA.
Let you do that. So if you buy it back before 30 days, your loss is disallowed.
Or buy it 30 days before you.
Right.
So if I sell something today at a loss, and I bought it 15 days ago, the same identical security, I would have a wash sale, and the IRS would not let me take that loss. Or if I buy it 15 days after I sell it, they still won't take it. So it's 30 days before or 30 days after taking a loss, they won't let you take it.
And we don't know when things are going to pop. History has shown it's a few days really make the difference, whether you in the market or out of the market. So
right.
You buy something similar but not identical, and then after that period of time has elapsed, you can go back and reverse it and own the thing that you originally owned. So we do that for a temporary recognition of a loss. If we still like that investment.
And again, a lot of times when you're taking a tax loss, you're not losing money on the security. It's just that for tax purposes, they've had distributions in those mutual funds, which drop the mutual fund below the tax cost bases, even though all that cash that they just gave me is over here in my money market fund looking to be rebalanced, that now I can go in and hit this thing, take a tax loss, and reduce the amount of capital gains that I have to pay taxes on. And a fund we've done this a lot with is the Templeton Global Fund. Templeton Global Total Return is corporate and U.S. government bonds, whereas Templeton Global Bond is strictly government bonds run by the same guy, same philosophy, many of the same securities, but it's substantially similar because this one has only government, this one has corporate and government. So even though there's a lot of crossover, it's not identical in any way, shape, or form. And they pump out a lot of cash and interest and dividends and all that kind of stuff. And so that you see this fund at a loss, and we can just go from this one over to this one and have Michael Hassenstab still managing the same thing with all the same opportunity, and yet lock the tax loss in.
Right.
And so, that's some
besides
of the
CPA in us.
Yeah, that's kind of good stuff. Now there are people getting a little crazy with the tax loss selling. They're literally going in and they're constantly, churning through that portfolio, wringing out every single tax loss.
And I've heard a case for that. As we reflect on that, if we were ever to apply that, we would go through a thorough analysis of it and then go to our clients and tell them what's going on ahead of time. But we're not there. But there are people who do that. They accumulate at any point in time, every day, and accumulate for the long term.
But you got to constantly be finding substantially similar funds to be doing that.
Oh, sure. It's a big effort.
And you got to make sure you're not doing any trading costs. It's absolute, no trading costs, and so forth. And also, you'll tend to find that this is only going to happen with, for the most part, you're going to see it more with a newer client than an older client, because an older client's going to own a lot of the indexes and a lot of the funds for a long period of time. And if our portfolio managers aren't turning their portfolios over, you're not going to see a lot of losses sitting there, even after distribution.
That's correct. So you can't avoid the tax man forever.
Yeah. Anyway, I think we've addressed we've only scratched the surface as to how we do these things.
We're trying to just give
it gives an idea that we're not just sitting here hanging out, telling jokes to each other, that there's a lot of work that we do on a day-to-day basis with the investments and so forth. So I don't know, did we ask for questions? Does anyone want to ask a question? You always feel free. There's a chat box there at any time. We'll give you a minute or two. If anybody does want to ask a question, we're happy to answer it. Or you can just email us and say,
sure,
why do you do this? Or why do you see that? Here, you got a question. So let's see what it says. I got to put my glasses on to see that. What is your ranking of factors, high to low, when evaluating a fund? Management, holdings, fees, strategy, performance, geopolitical, and what is the most important, least important?
Great question.
It is a great question. I'd say performance first and foremost.
Performance and management tenure, management makeup.
Absolutely, because, if we're seeing performance that's showing alpha in a portfolio, then we're interested. And because fees are already sucked up into that work.
Fees are there, and the security has come on the screen. It's paying for itself.
Right. The performance already reflects the performance in mutual funds, especially in ETFs. When we see it, is always net of fees. You're not going to see that in Morningstar or something where you're looking at fees and you got to subtract them out of what they're telling us the performance. Performance they're showing us is always net of fees. So if performance is out performing, doing what we expect, it's up here, as Chris said, in Washington, low volatility, low risk, high return, and that there's past history, of course, then we're interested in it. And now we're going to the management. Is the management that made this past performance still there?
We had a global fund. We had it for several years, and its performance was yellow, FI 360. And so we went to the management and just had a conversation with them. And they didn't give us any confidence that they knew where they were and what they were in the cycle and what they were going to do differently to change the trajectory of where they were going.
Yeah.
So after a few years, we said, okay, that's too much for us to take. We need to find something else.
Geopolitical is going to come into the factor because we want to be U.S.-centric. We want to be about 60-40 of our equity holdings, U.S. versus international. So if we've got a fund that's 90% international, now if I'm buying a global fund where they can go anywhere in the world, and I want my U.S.-centric to be 60-40, I want that fund to be in the 50-60% U.S. category. I don't want it to be too much higher, and I don't want it to be too much lower, and I want to see they stay in that category. But, holdings is also a big factor that we look at.
Mm-hmm.
Why do we look at holdings? And one of the things is that I've made a commitment to is I don't really want to own any fossil fuel companies in any significant factor. Now, it's nothing to do with climate change and so forth, and I'm not getting into that one way or the other, but I have a philosophy, and that philosophy is if governments are against something, do not be for it. If governments are for something, do not be against it. And governments clearly are against fossil fuels, and they will do everything and anything to make it difficult on fossil fuels. And
you go back and look over time, there are times when, yes, they've outperformed, but the volatility and just even the long haul, they don't outperform other asset classes necessarily.
Yeah, and there's also no doubt whatsoever that you don't want to own fossil fuels, because if you could just have a little thing that sucks up the sun or or something else that gets you all the energy you want. Who the heck wants to go drilling for oil and taking that poison, that gasoline, that oil or whatever that can pollute? And I don't want to go to a gas station. I'm going to be the first to buy an electric car when it's logical to buy an electric car. Get government out of the way, and I'll be one of the first to buy an electric car.
Well, now some people have done that already, and not that they're illogical. You wait for your trigger point.
I'm talking my trigger point.
Although
I'm not saying
that's good.
I'm not saying that anybody who bought an electric car, they were smart. They got all those tax benefits that government gave them, and work out. But holdings are a big thing. We want technology and healthcare out there because we believe that technology is going to continue to be a major driver of the world economies. You can see it. I mean, look at where consumers continue to focus more and more and more of their money. It's always towards
it's also
technology.
in the number of holdings, right? So if they own
who wants
1,000
stocks,
if you own
might as well just buy an index fund.
If you own 100 or more, you're essentially, so they've got this active share. So active share just is measuring, well, how close are you? You're calling yourself an active fund because a lot of funds are doing that, but you're really just buying an index,
right?
And keeping it there because you have so many holdings. So you've got to have under 100. We like it even less than that. We like people with high conviction and good track records.
And Steve,
and low turnover.
And Steve's question he didn't add in there is turnover, and that we mentioned that earlier. And turnover is a big thing because if an active manager is buying and selling, he's constantly got to be picking the best stocks of the year, and there's just no way. You pick great stocks. Warren Buffett has proved this. Pick great companies and hold them for a long, long time, and that's what our managers typically will do.
And people can do the other thing. We find that this is the more successful strategy,
more tax efficient to boot,
and that on top of it. So sure, great question.
That is a great question. So any others? I don't think so. Or they would have come up there, wouldn't they? Yep. So if not, if you have one, load it up. If not, I guess we'll wrap it up.
All day for now until our next
Consulate U.
Next Consulate U, but for now it's
next one. I don't know what the topic. Oh, the contrarian investor. Contrarian investor. What is a contrarian investor? Why do you want to even consider being one? What are the positives and negatives of being a contrarian?
Do you know what one of those are?
We'll find out. All right.
Sure. Thanks for being with us.
This is Tignanelli saying God bless.